Let me turn now to my next guest, who's looking across the options market for some different kinds of opportunity. Chris Murphy is co-head of derivative strategy at Susquehanna. I think Anton was even saying, Chris, he thinks shorting, we're getting back to financial guys, we shouldn't be able to short these financial stocks right now. If they moved to do something like that, what would the fallout be across the markets, do you think?
Well, I think the knee-jerk expectation would be for markets to rally, but when you get involved and disrupt things, and maybe that would be a sign of more concern. So I wouldn't necessarily think that would fix anything, and if anything, would probably lead to a heck of a lot more volatility.
Yeah, I'm going to bring Dom in here as well, because there's a lot of questions about the shorts people have already had position and if they're piling on right now.
The interesting part about the price action that we're seeing today, and this kind of harkens back to a little something that Anton brought up in the last segment, this idea that with right now, with what the Fed has done and what the Treasury and FDIC have done, you've in essence basically righted the left side of these bank balance sheets, right? The holdings that they have, you've basically said that these guys can pledge them as collateral at full par value, take out loans up to a year, maybe more sometimes, to kind of make good on these things. The problem right now is what you have on the right side of the balance sheet with regard to the equity side of things and the deposits and liabilities. If you start to move to restrict some of these trading activities, what you might then do is further, to Chris's point, disrupt what's going on with the kind of discovery of what's happening right now. I would also say that passive index investing is probably causing a lot of this because people don't just sell individual stocks anymore. They sell an ETF that holds these things, and by proxy, everything that goes in it goes down as well. The hard part about this is whether or not you can enact any kind of real trading policy or restriction to say that you can stem it without causing any kind of unforeseen market disruption, and that's going to be the real issue.
And what about those shorts who might have been on the banks that collapsed, Chris? What happened? Do people get to close those shorts out?
Yeah, I think that that would remain to be seen. I mean, we're looking at the options, and if you are concerned about that, volatility has gotten a lot more expensive. But if you're sitting on a bank stock that's down, a regional bank stock that's down 50 or 60%, you might want to look at some call spreads because volatility is kind of expensive, or calls just to cover against something like that happening. So in terms of what would actually happen, I don't know, but how to protect yourself, you can look to the options, calls or call spreads against your short positions.
Chris, I got an informational question just for some of the viewers out there. What happens if you've owned a short position or are long a put option, an option to sell, say, Silicon Valley Bank or Signature Bank? These companies are now done. You cannot trade them anymore. There is no trading activity. What exactly happens, and how do you realize profits, so to speak, if you're short that stock or if you own put options and are trying to kind of monetize them at this point?
Well, one thing to keep in mind is they're not going to be automatically exercised. Typically, if something expires in the money, it's automatically exercised. You're going to have to go out there and call your prime broker or whoever you do your options with and make sure that you exercise those options. We know, then of course you have a short position. This is going to take a long time for everything to get all figured out, but at least your options don't go away. So it is important to make sure that those options are officially exercised, even if the stock's halted or something like that.
Chris, can you also just quickly, before I let you go, as you said on Friday, we were approaching, in terms of VIX call open interest, approaching the 2018 Volpocalypse highs. What does the market look like today, and what does that tell you about what comes next?
It's interesting. The S&P is basically flat, but we're seeing the most dispersion under the hood that we've seen in a couple of years since I think the first COVID vaccine was announced. So market's flat, volatility continues to move higher. A big part of that is because a new downside tail risk has been introduced. We were pretty comfortable in general. We kept talking about why is the VIX so low? Well, it was a known risk, the Fed and inflation. Now all of a sudden there's a new unknown. We're seeing the downside tail risk of options being bid up, skew being bid up, and that's pushing the VIX higher even on a day when the S&P itself is flat.
Is that a bearish sign?
That would, typically when you see stuff like this happen, it means we're closer to the end. The problem is when you go back and do these back tests, so much of these back tests are when the Fed has been very friendly. Now the Fed has the opportunity to get a little bit more friendly coming up here. So, Fed being nicer to the market, yes, it is closer to capitulation. Not as effective when the Fed's being as hawkish as it's been for the last year or so.
Yeah, and that goes back to the importance of the CPI and some of these other reports that are going to come in and maybe change their mind about that. Good stuff, Chris. Thank you. Chris Murphy from Susquehanna. Tom, thank you as well.